Okay, episode 3 of the long-term perspective, premium and discount, right? One of the core foundations, right? Obviously, right, goes without saying, this is one of the most important concepts in our analysis. Always buy low, never buy high. Always sell high, never buy low. A dealing range is to be used both as a parameter for entry as well as a draw on liquidity, right? Longing from discount or shorting from a premium to discount, right? The market is always trading from a premium to discount or discount to premium. We want to profile the market on the lower time frame as price moves towards key levels within premium or discount, and this can help us catch both longs and shorts, right? To help us build in bias that we can work with almost on an everyday basis, right? Or every week basis. How do we define a dealing range? A bearish dealing range is formed after a swing high is ran, then price breaks through a swing low with an expansion leg. That expansion leg is your bearish dealing range. Split the range in half, that is your premium and discount. A bullish dealing range is formed after a swing low is run, then price trades through a swing high with an expansion leg. That expansion leg is your bullish dealing range. Split that in half, that is your premium and discount. Okay, so here is a diagram of what that looks like, right? So we have a low taken here and then a high broken through, okay? When we form a swing high here, okay, that's when you can anticipate this to be a dealing range low and this to be a dealing range high. You split that in half, this is equilibrium, right? Everything below is discount. Lower time frame, retracement against the institutional order flow, right? If this is a bullish higher time frame dealing range, this would be against the order flow. We can use this logic to trade both back down into discount and to continue with the order flow from a discount key level. Okay, bearish example here, right? A high taken, then a low broken through, a swing low forms here. This becomes your premium high to discount low. Lower time frame retracement, right? Lower time frame retracement against institutional order flow. So on a higher time frame, this is just going to look like one straight line up, but on a lower time frame, there's multiple opportunities that we can use to get into trade back into premium. Then we trade into a premium key level and we can look for a reversal from that premium key level. Okay, so here's an example on the higher time frame chart on NASDAQ. We can see the NASDAQ takes out this high, right? And then breaks through this low. Okay, so this is how we can define a dealing range. This high to this low now becomes our premium to discount. When a swing low forms, that's how you know the dealing range is in place. Okay, so now the dealing range is in place. We would map this high, right? The highest high and the lowest low. This becomes our dealing range, and we start looking for premium key levels that we can trade to, okay, for longs, and then sell from for the shorts. You can see the market trades up into the new week opening gap, premium PD array, right? Respecting 50% as well, then aggressively sells off. So on a lower time frame, you can see there's multiple opportunities here with stop runs below this low here, stop run below this low here to trade back up into at least 50%, right? We don't want to be aggressive with our TP going deep into premium when it's a bearish dealing range, right? But at least to 50% we can try catch lower time frame retracement against the higher time frame order flow. Then we hit a premium key level, right? Run out a short-term high, and then the market aggressively sells off in line with the higher time frame institutional order flow. Okay, looking at a low taken here, and then we break through a short-term high. Okay, after the market breaks through this short-term high, this low to this high becomes our dealing range. When do we anticipate it? After a swing high has formed, after the high gets taken, right? Then we map premium to discount, right? New week opening gap again used here, but we also have the lowest down close candle that took out sell side liquidity, that opening price, that's our discount key level as well. Again, we can trade the shorts back down into discount and then look for longs in alignment with the higher time frame order flow back up higher. So you can see all of these runs on stops and bearish fair value gaps. We could trade those as we're looking at this to be a retracement back down into discount. But then when we hit the discount key level, higher probability because it's in alignment with order flow, we can look for the market to trade higher than after we confirm some kind of change in the state of delivery. In this case, it would be the close above this IFVG. When we close above right there with this candle, we can then use this as inverse for longs to trade higher.